Hello there. I hope that you're doing well. Welcome to this new lecture on low resistance liquidity runs. Low resistance liquidity runs are one of the most important things to understand when it comes to viewing the markets through the lens of algorithmic price delivery. The reason why this is the case is because low resistance liquidity runs are the runs that are very aggressive and very sudden. So that means the moment that you enter a position, the market immediately begins to expand away from your entry. This is of course ideal and this is what we're looking for. And during this lecture, I will teach you certain signs that you can look for in order to anticipate low resistance liquidity runs of taking place. Let's begin with today's lecture. What is a low resistance liquidity run exactly? A low resistance liquidity run, or better known as LRLR, is a move from one key level to the next key level without much back and forth going. This means that these moves are quick and sudden. If you would take a look at a visual representation of a low resistance liquidity run, it would look like the following, where you would see the market drop into a key discount level, form a low there, and then begin to show signs of bullish order flow stepping in. We would see the market begin to expand towards the upside, retrace, form a low, then expand towards the upside, retrace again, form a low, and then make the final push higher into the opposite side of the range or the opposing key level, which is of course a buy side liquidity pool. This is a very quick and sudden move towards the upside. This is what is called a low resistance liquidity run. If we would take a look at the bearish scenario, it would look like the following, where we would see the market begin to show signs of expanding into that key level on the upside, forming a high, and then begin to show signs of bearish order flow stepping in. We would see an expansion towards the downside, followed by a retracement higher, followed by a further expansion towards the downside, followed by a retracement higher, followed by a new expansion towards the downside, delivering into the key level of the sell side liquidity on the downside right here. This is of course again a low resistance liquidity run, where there are not many retracements and where the market simply expands, retraces, expands, retraces and expands. And that right there is the sign of a very quick and aggressive market. And that's of course the market that we would like to look for entries in. Because you need to understand that there's also an opposing side when it comes to low resistance liquidity runs. And that's one of the things that I want to discuss with you. I want to share with you why recognizing low resistance liquidity runs is so important. Why is it crucial to know when low resistance liquidity runs take place? Knowing what sets up a low resistance liquidity run allows you to avoid high resistance liquidity runs, better known as HRLR. Understanding what sets up a low resistance liquidity run provides you with the highest probability trade setups. Let me show you some examples of what a high resistance liquidity run can look like. Here we can see a bullish example where we saw the market drop into the key level on the downside, show the signs of a swing low formation, followed by the signs of bullish order flow stepping in. Notice how much back and forth going there is before the market begins to expand slowly towards the key level on the opposing side of the range. This right here shows that there's a lot of consolidation that's taking place during each retracement phase. And because it is the case, this is a high resistance liquidity run environment in which there is a lot of resistance towards the upside, meaning that price is struggling with moving through the price levels right here, and that it's tapping those levels many times and rejecting them before it's finally allowed to displace above them. And that right there is a sign of a slow market, a market that's not in a rush to get to this key level right here. For the opposing side, it would look like the following, where we would see the market expand higher into the key level on the upside, showing signs of a high formation, followed by an expansion towards the downside, showcasing signs of bearish order flow stepping in. From that moment on, we would see whether or not we would see retracements followed by expansions towards the downside. If we, however, would see the market begin to consolidate inside of this first retracement leg And also in the second retracement leg, we know that this is a high resistance liquidity run environment. It's already all over the charts. However, how can we anticipate this in advance? How can we anticipate where a low resistance liquidity run is likely to unfold from? Because you need to understand that a high resistance liquidity run can set up the beginning of a run. However, the half part or even the final part of the move can be a low resistance liquidity run. And that's what I want to touch on as well during this lecture. So far it has been a lot of theory. I've shared some theory insights with you. And when it comes to anticipating low resistance liquidity runs, you need to understand that the economic calendar is by far your best friend, because the economic calendar shows you on what days you can anticipate either low resistance or high resistance liquidity runs to take place. I will create a lecture later on how I navigate the economic calendar. But for now, what's very important to understand is that low resistance liquidity runs can already be anticipated based on purely the market. And that's what I'm going to touch on now. And therefore, I'm simply monitoring to see whether or not the dollar will manage to get above this down close candle. The moment it gets above this down close candle, I want to see it function as support on price. I'm not waiting for a wick above that level. I'm not waiting for simply a tap above that level and then it should function as support on price. Now I want to see displacement above it. I want to see signs of strength that we displace above this price range, and then I want to see it function as support to draw towards the upside. In order to understand where low resistance liquidity runs take place purely based on the technicals, I'm going to showcase to you certain animations that will make this clear to you. You have just witnessed my analysis for DOR that I provided to my mentorship students during the Tuesday review, Tuesday the 18th of June, and I'm going to share with you why that specific price range was important to me. What I want you to see is that within this current chart that you're witnessing, you can see the market expand towards the upside, forming a high. You then see the market begin to show signs of weakness and a low gets formed. The market then retraces and forms a new high. Notice that this high is lower than the previous high that was formed. The market then expands away from that high that was just formed towards the downside. We form a new low and the market begins to retrace back into that old low that was formed. The market forms a new high here and continues to expand towards the downside. We already know that that old low that formed prior to the setting up of the lower high, that old low will be a crucial reference point for IPDA to refer back to in the future. So that means that if the market is going to find resistance in there, we know that price is likely going to expand towards the downside. The moment the price displaces above that price range of that old low, we can anticipate the market to find support inside the price range. This will also assure the fact that we can then anticipate that old low to function as support on price. The moment that we see the market displace above that old low, we can anticipate speed and velocity towards the upside towards that initial high to take place. I understand that this might be a bit confusing for you and that it's a lot of talking by me, but I hope that this visual representation, this animation, is making it clear to you what I'm exactly saying to you. The moment that we displace above that previous low that was formed, the red box, we can anticipate that to function as support on price, and then we can anticipate the continuation higher to take place, and this move will be a low resistance liquidity run. Let us take a look at the review that was shared on Thursday to see whether or not this analysis was in fact still on the table for me. I like the fact that we formed a low on Tuesday. That's good for me, and that on Wednesday we simply consolidated. However, what could confirm to me that Tuesday is the low of the week is if we would displace above this CB, displace above the Tuesday high, displace automatically also above this range, and then utilize it as support to draw higher. And that's why it's important to utilize multiple time frames for your analysis, because That right there is how you can gauge order flow and how you can anticipate whether or not we're going to see continuation higher take place. And this is also what allows you to recognize low resistance liquidity runs. Here we are on the hourly chart of the door. As you can see, we can see the past week's delivery on the door. I want to share with you why I anticipated Thursday and Friday to form the highest probability trading setups when it comes to low resistance liquidity runs. Notice that within all my mentorship reviews, the clips that you just were showcased earlier during this lecture, I was referring to this one very specific price range of this downclose candle. Notice that this is not a big zone. Notice that this is not a big price range. No, it's this very specific price range from this candle's low to this candle's high. That was the price range that I was monitoring all throughout last week. That was the price range that would confirm to me that the dollar would expand higher towards the buy side liquidity. As long as we stayed below it, I was neutral on the dollar. But the moment we displaced through it, I would anticipate it to function as support on price to then continue towards the upside. Let us take a look at this delivery to see exactly how the dollar delivered in respect to this price range. What I want you to see is the following. I want you to see first of all how on Friday right here of last week, so not the past week but the week prior, we had this expansion towards the upside. From the midnight opening, we saw this very aggressive run towards the upside. We formed a high right here and then we dropped lower. We then formed a low in this area and we ran up higher during the Sunday opening. We formed a high on Monday and we then begin to displace towards the downside. Notice that we displaced below this downclose candle. The moment that this occurs, this downclose candle is immediately on my chart. Why, you might be wondering. The reason why I'm paying so much attention to this downclose candle is due to the following. This downclose candle is now a bearish mitigation block. Why is it a mitigation block, you might be wondering. It's a mitigation block due to the following. We formed a high right here, we formed a low, and we then formed a lower high on Monday. Notice that we then displaced through this downclose candle with what? With a CB right here. A CB, an imbalance, or the formation of any imbalance, so either a CB or a BC, is only significant when it occurs through a very specific price level or price range. That's why imbalances work. That's why they function as support or resistance. When we see that displacement through this downclose candle has to be extended on the charts. Notice that during the Tuesday review, I outlined that as long as we would stay below this downclose candle, its respective price range, I would be neutral on the dollar. But the moment we displaced above it, I would be bullish. We then see on Tuesday the market tap above the price range of the downclose candle, but notice that we wick above it and reject it. This right here is not displacement. I even said on Tuesday that simply a wick above it was not enough for me to turn bullish on the door. Why not? Because displacement occurs with speed and velocity, with the market literally screaming, I'm gonna run higher. And that right there is the sign you need to be looking out for. And how does that occur? How do you confirm that that takes place? That occurs when you see the creation of an imbalance. But anyhow, what we see is that we reject this price range on Tuesday and we expand towards the downside, forming a low. On Wednesday, we had a bank holiday, so the market simply consolidated and we did not see any significant delivery at all. Then during the Asia session, however, a buy program began, where we began to see the market expand towards the downside. On Thursday, we opened up, formed a low, and immediately began to run higher. Notice that we created a BC right here, and we then begin to see the market show signs of respecting this BC. We begin to show signs of trading into that downclose candle with respective price range, retracing, but notice that we're not displacing towards the downside. We're just hanging around that price range. Then eventually, during the lunch session, during the afternoon session, we begin to see signs of the market displacing through that price range. We see this huge upclose candle which screams displacement. This right here shows that order flow is now significantly bullish. Notice that a BC gets created right here, and that BC lines up exactly with the price range of the down close candle. The price range that we had on our charts all throughout last week. This was exactly what was outlined days in advance. This movement right here. The market finds support inside that price range and it trades away from it. Notice that we do not expand during the Asia session towards the upside. Instead, we expand towards the downside. Why does that occur? Because what they're doing is the engineering buy-side liquidity above these relatively equal highs. The market trades into that price range again, forms a low, and immediately begins to run higher aggressively, trading above the buy-side liquidity, resting above this high. Notice that this right here is a low resistance liquidity run. But what I want you to understand is that within this fractal, from this candle's high to this candle's low to around here, we see a market maker buy model fractal unfold. However, what I want you to also understand is that the market maker buy model unfolded prior on the lower time frames, from this high to this low to this price level right here. So what you're seeing is that multiple market maker buy models are unfolding from that same very specific price range. And that right there shows to you how many opportunities can be present simply by using this one specific price range. And that right there shows a level of algorithmic precision that's absolutely undeniable. And if you think that this right here is simply buying or selling pressure, then I highly suggest you to stop watching this lecture, because you really need to rethink your perceptions about the financial markets. Because I don't know how much proof you need every single week that these markets are absolutely. Let us take a look at another example of last week in which a low resistance liquidity run was anticipated. Right now, I'm wanting to see whether or not we will manage to stay above these highs. If we would displace below this BC right here, then that could be a warning sign of a high of week potentially being in. But again, I'm not trying to capture a high. It's possible that we might see a Thursday reversal. If that is the case, then this level right here will be the confirmation to me of that occurring. Notice that this lines up with the 20,250 level. And what I would be targeting then is the sell side liquidity below this low right here, the Tuesday low, and maybe even the market trading into this BC right here. The next scenario in which a low resistance liquidity run can be anticipated based on the charts is the following. Where we see the market expand towards the upside, forming a high. We then retrace and form a low. The market then continues to expand higher and it creates a higher high relative to the previous high. Notice that we then begin to displace towards the downside, and we displace through a very specific price range. We displace through an imbalance or sequence of imbalances that formed inside that final run higher. The moment that this occurs, we want to see those imbalances or that specific imbalance function as resistance on price. If it does function as resistance on price, we can anticipate speed and velocity towards the downside to take place, because it signals that the market is too weak to retrace deeper into that leg lower that just took place. Instead, we simply tap into that price range that is annotated by blue, which is called an inversion for value gap, and we begin to form a high there to then expand lower aggressively. This right here is one of the strongest algorithmic signatures that you can be looking for. Notice that this also lines up with a bearish breaker formation. Here we are on the hourly chart of Nasdaq, and we can see the full delivery of the past week. What I want you to see is how on Thursday we formed a high right here after we have been running up higher all throughout the beginning of this week on Monday, Tuesday, and Wednesday. On Wednesday, we of course had this bank holiday as outlined earlier during this review. Notice that within my mentorship review, I put emphasis on this very specific price range of this BC right here, which formed at a key level. Notice that I said exactly that if we would displace through that level, I would want to see that price range function as resistance from price to then aggressively deliver towards the downside. The levels that I then would be targeting are the sell side liquidity resting below this low and this BC right here. Notice that on Thursday we formed this high, begin to roll over, displacing with this down close candle through this BC right here. The next candle opens up, offers buy side, and immediately rejects that price range and delivers aggressively towards the downside. It takes out the Tuesday low, the sell side liquidity resting below this low, and it then closes higher. Eventually we roll over even more, delivering this BC as well, but notice how we traded below that blue box aggressively. The next candle, the next hourly candle opens up, offers buy side and immediately offers sell side. This right here is a typical low resistance liquidity run in which there are barely any retracements and in which the market is so heavy. This right here is what some refer to as a crash or a very aggressive repricing lower. Investigate how the left side of the curve was crucial in setting up this low resistance liquidity run on the right side of the curve, because that is one of the main takeaways that I want you to learn from this lecture. It is that the left side of the curve determines how the right side of the curve is going to deliver. And that right there is something that you need to write down somewhere because it's a crucial note to keep in mind. The past determines how the future will deliver, meaning based on the past, we can anticipate what will happen in the future. And that's where time and price sequences come in play. We see low resistance on Thursday towards the downside into the weekly opening, which I did not have annotated, but you can investigate that for yourself. And then on Friday, we simply chop around because the weekly delivery had already been completed. The final animation that I want to share with you in order to understand low resistance liquidity runs is the following. This animation showcases first of all a run higher. The market forms a high and then retraces lower. This retracement forms a low, which then sets up a new run higher, creating a higher high. The market then suddenly drops lower aggressively, creating a lower low. From this moment on, we know that the last down close candle inside of that first retracement leg is a bearish breaker. We're now monitoring to see whether or not it will function as resistance from price. We can see that the market expands higher, trading into that down close candle. We form a high again and we trade lower aggressively again. We take out the sell side liquidity resting below the low that formed prior, and the market then begins to show signs of strength, trading above that bearish breaker its respective price range. Now, what the majority of people would do is they would remove this bearish breaker because they would think, oh, it holds no significance anymore. Oh, it is not relevant anymore because price broke through it. This is false. Why? Because this bearish breaker is now an inverted bearish breaker, meaning it should function as support on price if the order flow is bullish. What we see is that the market forms a high and then begins to retrace into the price range of that bearish breaker. We form a low there and immediately begin to run higher. And that's what this whole lecture has been about. Notice that I'm sharing this all the way at the end because I only want the ones that are able to stick to the end to get this piece of sauce, so to say, of valuable information. I want to filter out those that are weak-minded. I want to filter out the people that are not willing to dedicate just a little bit of their time in watching this lecture till the real sauce gets shared. That's just how I teach, because I believe that you need to develop patience, and you develop patience by first of all watching through my lectures, and these lectures are of course not that long. Back to the topic of discussion. This price range of this bearish breaker should be extended to the chart, meaning it should function as support on price if the order flow is bullish. If that does occur, we want to see this down close candle get utilized for the expansion leg higher next, targeting buy side liquidity. Now the reason why low resistance liquidity runs take place the moment that we displace above these price ranges or below them, as I've been outlining during this lecture, is due to the following. Because there are no levels in between the current price and the potential draw on liquidity that could function as a roadblock, so to say. Meaning there is literally nothing that's standing between the current price and the target. And that's why the market will seek to reprice aggressively and quickly and suddenly. And that right there is what a low resistance liquidity run defines. And that is where the simplest and most objective entries take place. And the moment we enter, we can easily anticipate big green or big down close candles to take place. And that is where speed and velocity injections take place. I hope that this lecture has provided you with the insights required to understand when and where low resistance liquidity runs are likely going to take place. I want to thank you for watching it all the way to the end. Please let me know in the comments if you enjoyed this lecture and whether or not you want to see more. Please leave a like as well. And I look forward to catching up with you in the next one.